This is Ethos Ltd stock chart, and the current price is hovering near a critical support level of 3,098.70 Indian rupees. The stock has experienced a significant pullback from its peak of 3,547.43 Indian rupees, marking a decline of approximately 12.66%. This support level is crucial for investors to monitor, as it could either provide a bounce-back opportunity or signal further downside. Watch for buying interest around this level, which could indicate a reversal, or be cautious if the price breaks below support, which might trigger additional selling pressure. Ethos Ltd, India's largest luxury watch retailer, currently has a market cap of 7,586 Indian rupees crore. With a price-to-earnings ratio, PE, of 86.3, the stock is valued at a premium, reflecting strong growth potential in the luxury market. The luxury watch industry is expanding, with Ethos holding a 13% market share in India's premium segment and a 20% share in the exclusive luxury segment. As demand for high-end timepieces grows, Ethos is well-positioned to capture further market share, driven by rising disposable incomes and an increasing appetite for luxury among Indian consumers. Ethos Ltd's current price-to-earnings ratio, PE, is 86.3, significantly higher than its historical median PE of 70.2, as shown in this chart. Over the last 5 years, Ethos PE ratio has generally fluctuated between 50 and 100, reflecting investor confidence in the company's growth potential. The higher PE today suggests the market is pricing in strong future earnings growth, but it also raises caution as the stock may be overvalued compared to its historical averages. Investors should weigh the company's growth prospects against the risk of valuation contraction if earnings don't meet market expectations. Over the past 5 years, Ethos Ltd has shown strong financial performance, with compounded sales growth of 18% and an impressive compounded profit growth of 44%. Particularly in the last 3 years, sales growth has accelerated to 37%, while profit growth surged by a remarkable 160%, reflecting the company's consistent expansion and operational improvements. Generally, a growth rate above 20% is considered excellent, and Ethos has managed to achieve that consistently in both sales and profits, highlighting its strong foothold in the luxury watch segment and its potential for further growth in the industry. This chart represents Affle India, currently trading near a support level at 1,508.97 Indian rupees. After reaching a high of 1,750 Indian rupees, the stock has experienced a pullback, down approximately 13.74% from its peak. This support level is a critical zone for traders and investors to watch, as it may either trigger a bounce back or signal further weakness if broken. Investors should monitor the price action closely around this level to make informed decisions. Historically, the stock has rebounded from such support levels, but caution is warranted in case of further downside pressure. Affle India, a leader in digital advertising for mobile devices, uses a unique ROI-linked model, focusing on cost per converted user, CPCU, rather than traditional models like CPC or CPM. The company has grown through strategic acquisitions and continues to enhance its consumer platform with cutting-edge tech, acquisitions, and R&D. From FY19 to FY24, Affle achieved impressive revenue and PAT growth, with CAGRs of 49% and 44% respectively. About 73% of its revenue now comes from emerging markets. With its strong business model, strategic expansions, and network effects, Affle is poised for substantial value creation and industry-leading growth. Affle India Ltd, a leading player in digital advertising, currently has a market capitalization of 21,981 Indian rupees crore. The stock is trading at 1,566 Indian rupees, with a price-to-earnings ratio, PE, of 69.2, reflecting strong growth potential. While the PE ratio suggests the stock is valued at a premium, it indicates investor confidence in the company's future earnings prospects. With a return on capital employed, ROCE, of 16.2% and a return on equity, ROE, of 15%, Affle has demonstrated strong financial performance, making it an attractive investment in the fast-growing digital advertising space. Affle India's current price-to-earnings (PE) ratio is around 69.2, which is slightly above its historical median PE of 66.7, as shown in this chart. Over the past 5 years, the PE has fluctuated significantly, reaching peaks above 150 and dipping below 60. The current PE suggests that investors still have high expectations for Affle's future growth, despite the stock being valued at a premium compared to its historical average. While this premium could indicate strong growth potential, investors should carefully evaluate whether the earnings growth justifies this elevated valuation level in the long term. Affle India Ltd has demonstrated strong growth over the last 5 years, with compounded sales growth of 49% and compounded profit growth of 44%. Notably, over the last 3 years, sales growth has accelerated to 53%, reflecting the company's ability to scale rapidly in the digital advertising space. Consistent growth above 20% is typically seen as strong, and Affle has consistently outperformed this threshold in both sales and profits. This impressive performance is driven by Affle's robust business model, strategic acquisitions, and growing market share, positioning it well for continued success in the fast-evolving mobile advertising industry. This chart represents Fine Organic Industries, currently trading at 5,055.10 Indian rupees, near key support level. The stock has seen a significant decline from its peak of 7,000 Indian rupees, down by approximately 27.79%. This support level has acted as a strong price zone in the past, and traders will be watching closely for a potential bounce. However, a break below this support could lead to further downside pressure. Investors should assess whether this support holds in the coming sessions, as it could indicate either a reversal opportunity or additional selling pressure. Keep an eye on this critical level. Fine Organic Industries Ltd, a leader in oleochemical-based additives, currently has a market capitalization of 15,499 Indian rupees crore. The stock is trading at 5,055 Indian rupees with a price-to-earnings (PE) ratio of 43.9, reflecting its premium valuation in the specialty chemicals space. This PE suggests that investors are optimistic about the company's future growth potential. Fine Organic boasts a strong return on capital employed (ROCE) of 29%, demonstrating efficient use of its capital to generate profits. With a consistent track record and dominant position in the market, Fine Organic remains a key player in India's growing chemical industry. Fine Organic Industries' current price-to-earnings (PE) ratio is around 43.9, slightly below its historical median PE of 44.6. Over the past 5 years, the PE ratio has fluctuated, peaking significantly above 100 and dropping to lower levels during market corrections. The current PE indicates that the stock is trading near its historical average, suggesting that investors continue to value the company highly based on its growth potential. With a strong financial performance and consistent demand in the specialty chemicals space, the stock's current valuation appears fair, aligning with its historical trends in market pricing. Fine Organic Industries has showcased consistent financial growth over the last 5 years, with a compounded sales growth of 13% and compounded profit growth of 23%. Despite a dip in recent profits, the company has maintained its operational efficiency, as indicated by its healthy operating profit margins, OPM, ranging between 19% to 26%. Over the last 3 years, the company's profit growth surged to 47%, well above the 20% threshold, which is typically considered strong. Fine Organic's ability to sustain consistent growth amidst fluctuating market conditions makes it a solid player in the specialty chemicals industry.